The economy is so far defying expectations of a recession, is holding up a little better than a lot of people, including me, have expected. But I wouldn't sort of put too much on it, frankly. I mean, if you look at that GDP number, as you say, it was a way down from the previous quarter. A lot of the increase was government spending and trade being a result of a falling dollar, which still contributes to GDP, but we have to look at what was the reason. And I think the critical thing, Michelle, is what Powell himself, Jerome Powell, the Fed chairman himself, commented in his last press conference, quoting Milton Friedman from 40 years ago. The monetary policy works with long and variable lags. So some things like autos, housing, which are very interest rate sensitive, they respond to increases or decreases, for that matter, in interest rates very quickly. And we've seen that with housing and both in Canada and in the US. Housing and autos respond quickly. But other things, those lags can be as long as a year or 18 months. People forget that. So when people like me say we are heading for a recession, I don't think there is any way the US will avoid a recession. And I'll stick with that.
Right.
Remember, we only started raising rates, in April last year? So it's been less than 1 year. And typically monetary policy has these long lags.
Yeah.
So you look at the retail spending, for example. That's one thing a lot of people have pointed to. Retail spending is holding up. That means the economy is doing strong, and the consumer is a lot more in a much better position than it was feared. And I say baloney. You look at retail spending, it's basically flat, marginally up over the last 8 months since rates started going up. With inflation at 8%, retail spending should be going up for the consumer to be buying the same volume of goods. So the fact that it's flat means the consumer is actually retrenching, buying less or buying lower quality goods. And retail spending tends to have a long lag because and this is perfectly typical. What you see is they start using savings, and the savings have gone down dramatically in the US. We've eliminated all of the savings from the COVID lockdowns in the US, and then credit card debt starts to go up. We're seeing that now, and in the last month, various credit card companies from Discover to Chase have all talked about the increase in credit card debts and the increase in write-offs. So that can only go on so long. You can only continue to spend from savings and credit card debt for so long.
Yeah.
So we're going to see consumer spending drop in the next few months, and it's all pointing towards a recession. The market is almost 100% on 25 basis points. I think one thing we can say is it's almost. I don't think anyone. It would be unbelievable if the Fed came out and said, well, we're not going to raise rates this quarter. So any surprise is going to be on the higher rate, not on the lower rate. But I'm expecting 25 basis points. But the real key is what Powell says in the press conference afterwards. That's the real key. I think gold is vulnerable to a pullback because the market is so convinced it's 25 basis points and a pause in March. If Powell comes out, Powell doesn't like the fact that the stock market is continuing to go up,
right,
which means the stock market is not taking him seriously. And so his incentive, I think, is to come out and say something strong. But we're going to keep on with this job until inflation's defeated, blah, 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 blah. He's not going to say we're not going to raise rates in March. He's not going to say that, I don't think. The real risk at the moment is at the government level and at the individual retail level, the individual consumer level for the bottom half. The bottom half in terms of income and assets in the US have no savings at all, zero savings. So as rates go up, it means that credit card, the average on credit card debt is now 19%. And on a lot of cards, if you're a bad borrower, it's 25 to 30%. That's a killer for a person who's got debt and doesn't have any savings. So I think we're going to feel it at the consumer level before we feel it at the corporate level. The corporate level is fairly strong in the U.S. Employment is another thing that tends to have a lag. When you think about it, if you've, especially in this sort of employment situation that we have, everyone's been talking about how employment is so tight and how it's so difficult to hire new people. Well, in that environment, you tend to hang on to people a lot longer than perhaps you might otherwise have done. And of course, for small businesses where your employees, you tend to be very reluctant to lay off people who work for you and work well for 5 years, 10 years. You don't really want to lay them off. So you hang on to people longer than perhaps you should on a purely economic matter, on a purely economic basis, but then the point comes where you have no choice. And so employment layoffs tend to have a lag as well. And the ones you just mentioned are just a reflection of what's going on across the country.
Yeah.
With smaller businesses laying off people. If you look at Hong Kong, Europe, Britain, they've all had their own particular things. Hong Kong, of course, with the China reopening,
Sure.
They were locked down for so long. Valuations in Hong Kong just got stupidly cheap. I mean, ridiculously cheap. China reopens. Obviously, that's bullish for Hong Kong. And you look at Europe, where the fears of a desperate winter were not, the weather has been, I should say, not was, because we haven't finished winter yet, but has been better than expected so far. So those worst fears have not come. And of course, in Britain, you had, with the political circus going on there, stock prices got very, very cheap, and the pound declining helps because most of Britain's FTSE are exporters, most of them.
Right.
So that helped. When you look at the S&P, we didn't have those sort of circumstances. We hadn't just come out of a lockdown. Stocks were not ridiculously cheap to begin with. I think the S&P is heading for a fall. When you look at the S&P right now, it's trading at 18.5 times earnings. Bear markets do not end at 18.5 times earnings. If this bear market is over, it will be one for the record book. It really will, one for the history book. Bear markets do not end at 18.5 times earnings, which is well above the average multiple for the S&P for the last 40 years. The second thing is you look at the S&P last year, it did 226.5 or something dollars per share in earnings. Consensus analyst expectations for the coming 12 months are 226.1. Consensus estimates are that the S&P earnings are going to decline by less than 1%, considerably less than 1%, right? Considerably less than 1%, basically flat. How can that be true when you look at the earnings we've already seen from Apple and from Microsoft, when people are laying off people across the board, when the economy's slowing, when the consumer credit debt, is at record levels? How can it be true, but we're not going to see a decline in earnings this year? The Fed is going to continue with this job until inflation is under control. Now, interestingly, if I may, 2% to me is not killing inflation. 2% is perverse, to me is perverse for a central bank to say we want 2% inflation. They should be targeting 0% inflation. But that's a different issue. What makes gold bullish is not if interest rates are going up, not if inflation is high. That's not what makes gold go up. But if the market believes, if interest rates are going up, but the market believes that the Fed will not continue to raise rates until inflation's under control. We saw that very clearly in the 1970s. People forget, everybody talks about how weak Arthur Burns was, but Arthur Burns was raising rates consistently, quarter after quarter after quarter. Interest rates were going up, but he was always lagging inflation, and the market did not believe that he had the conviction to continue until the job was done, and the market was correct. When Volcker came up, he put rates above the rate of inflation, and the market believed he would do the job, and gold collapsed. Right now, my focus continues to be on the senior stocks, both the miners and the royalty companies, because those are the surest, those are the first to move and the surest to move. Already the XAU's up, over 35%, 36, 37% since the lows in October. But those stocks still have much more room to move in the near term, I think. So my focus continues to be on the seniors, right? Because
The Newmonts, the Barracks.
yeah, because they're the surest to move, you know. But I also think now is really the time to also start adding the juniors and the exploration companies. The exploration companies are stupidly cheap right now as a group. The problem, of course, is that you have to be much more discerning about what you buy. And the volatility not only is the volatility higher, but the risk of certain companies just not performing is much higher.